I'm here with Scott Andrews of Master the Gap. Scott, thanks for joining us.
Thank you.
Well, with your gap trading strategy, you've seen students make mistakes. You've made mistakes, I'm sure, in executing the strategy. Can you talk about some of the most important ones you think that people should avoid?
Oh, sure. As you can see here on this slide, there's at least 12 that I've identified and sort of grouped. Most of these, quite frankly, were mistakes that I made as well in my early days, and I've named them to help me remember them to make sure I'm not the shooter today or I'm not the news junkie today. But also when I work with folks, it's real easy for me to see what type of personality they are and what kind of mistakes they're probably making. So we name them and I have a little fun with it. The first one here is the shooter. And this is the person that knows that historical probability of all gaps filling is about 70%, right? So why wouldn't you want to trade all of those things? Catch 7 winners out of every 10 trades. That sounds great in theory. In reality, it doesn't work quite that well because you have to use a stop. You start using a stop and all of a sudden you're not making any money. So I like to joke the shooter is just so gung-ho on catching all those winners because it makes them feel good. They don't make any money and they actually end up shooting all their bullets. They get eaten up on transaction cost and it generally doesn't work out well.
So the question then becomes, how do you know which of these trades to take to fall into that 70% of the ones that will fill?
Great question. I used to play them all myself and I shot a lot of bullets and I ran out of my bullets. So I started doing a lot of historical back testing to determine which gaps had the best probability of filling. And I use a real simple concept. It's all based upon gap zones, just a term I used to describe where a gap is occurring in the morning relative to the prior day's open, high, low, and close prices. Take those 4 lines, that makes 5 zones, and that's the starting point for my gap strategy.
Let's talk about some of the other mistakes that we can hopefully avoid.
Sure, the competitor, and most traders that I know are intensely competitive. Some are more extroverted, some are more introverted, but deep down we're all highly competitive people. And as you can see here on the slide, they're more focused on win percentage and not on profit expectancy, you know, actually making money, because it feels good to be a winner, right? You know, a competitor wants to be a winner. We tie it to our self-esteem. We sleep better at night when we feel like a winner. But over the long haul, and believe me, I've gone down this path, and our desire to become a winner, especially as a gap trader, because you're trying to capture that nice big move that tends to flush fairly quickly. Gaps fill within an hour, hour and a half on most cases. And our desire to do that and be a winner, we end up scaling out at early targets like at half gap fill, and we increase our stop size, because if you use a bigger stop size, you have a little bit more wiggle room, you'll catch more of those winners. So if you think about it, you're going to be eating like a mouse, as they say, and defecating like an elephant. So that doesn't work well. So as I like to remind people, the competitor, the ultimate competitor, is the one that makes money, not that just wins a bunch.
I think we have time for one more.
Down below, you'll see the myopic, and that's the person that is judging success trade by trade or week by week. I have a lot of people that come in, we have a trading room and they follow us, and or that even try new strategies, gaps or not, and they get so focused on that first trade or the first series of trades, and they will throw the strategy out if they happen to have 1 or 2 losers in a row. And that's just crazy if you think about it. You know, ultimately everything in the markets is driven, has historical probabilities over time. So if you have a winning system or a winning strategy, the last thing you want to do is to try to judge it on the first 3 trades. That's not, A, it's not statistically relevant, and B, it could be the worst decision you've ever made. Now, it's hard psychologically. I recognize that. It seems like to me when I increase my position size, which I tend to do each year, I used to increase position size after I'd had 3 or 4 winners in a row, and I learned the hard way that that was not the right time to increase position size, because I'd go through a series of losers right after that, after I increased position size. So it's hard. You can't, but you got to stick with your system, and don't focus on the short term, focus on the long term.
Thanks, Scott, for your time.
Thank you.
You're watching the MoneyShow.com video network.